If the recent market sell-off made you nervous, take a breath, because Tom Lee just called it what smart money loves to hear. This pullback is a buying opportunity. Lee, co-founder and head of research at Fundstrat, jumped on Power Lunch to break down the day's action, why the VIX spike matters, and why the bigger bull story isn't broken. In a moment, I'll roll a short clip so you can hear him say it in his own words, then I'll give you my reaction and show you exactly where I think the edge is right now. After that, we'll dive into 3 undervalued stocks I'm watching that lineup with his framework, names with real catalysts, real cash flow, and room for multiple expansion. If you want more clear, no noise breakdowns like this, like, share, and drop your thoughts below. And if you're new here, hit subscribe so you don't miss the follow-through update I'll post after the next move. Alright, here's Tom Lee.
Tom, it's only one day. We get it. We're still, the bull market we heard earlier, still intact. But your take on today's move and what may lie ahead?
Well, Brian, it may be overdue to an extent. We've had a nice rise of 36% since the April lows, and I believe today's decline is the biggest in more than 6 months. But it's good to see the VIX spike. The VIX spiked at 1.29% today. That's the 51st largest ever spike in the VIX. So we're a top 1% move in sort of what I'd say the market seeking safety. And so I think it's a good flush that's happening today. I would like to say the market is, concerned, but as your other guests have said, especially Rick, I mean, unless there is a real structural change, this pullback is a buying opportunity.
Wow, 51st biggest move for the VIX. So why is it good that the VIX is responding? What does that signal?
It shows you that investors are seeking protection. And as the VIX is a measure of expected volatility of the largest 100 stocks. And so a spike in the VIX is really a market saying, okay, I need to get out of everything, but I can't sell everything. So let me hedge it by buying volatility. And that is usually a sign of an interim low. I mean, I don't want to say I think markets are bottoming today, but we know that the forward returns are pretty good 1 month and even 1 week later. So I would say if someone says, are we higher a week from today? I'm going to say the odds are actually really good. Or, we might even be 60 points higher.
Well, wow. But that's happened. That's what's been happening, as we talked about earlier in the show, Tom, that we've seen these buy the dip buyers come into the market. We get a day like today, the dip buyers come in, we're higher a week later. Do you expect that to happen again, absent some further escalation with China?
Yeah, I mean, anything's possible, Brian. And I think that the markets lived through this February to April, and it was a day by day panic, and maybe there's echoes of trauma people are thinking about, and we do know that this. These are important issues. So I wouldn't want to be glib in saying, hey, this is nothing, because the market is making a big move. But to me, if I said, okay, what are the reasons stocks have been attractive for the past 12 months? It's been about the innovation coming from AI, and it's the innovation as Wall Street looks onto the blockchain, and now it's the Fed that's beginning an easing cycle. These 3 things have structural tailwinds that aren't disrupted because of potential even rare earth dispute with China.
Do you want to see the market not end on its lows? We're not on our lows right now.
Well, it's Friday, and it's a long weekend. So as you know, a lot of people like to shut down their computers. So I wouldn't be surprised if we might see the market close on its lows, but to me, I don't think it's a signal. As you know, markets rarely bottom on Fridays anyway, so maybe Monday is the flush, but then, that's the buying opportunity.
What Tom's really saying is, don't confuse a sharp down day with a change in the bigger story. We've rallied hard, about 36% off the April lows, and today's drop is the biggest in more than 6 months. That kind of shakeout pulls the fear gauge higher, and in this case, he points out the VIX had a top 1% style spike. Why does he like that? Because when volatility jumps like that, it's often a sign that investors are scrambling to buy protection rather than dumping everything outright. In plain English, people hedge when they're nervous, and that rush to hedge can mark an interim low rather than the start of a deeper bear move. Let me unpack that. The VIX is built from options pricing on the S&P 500, so when it spikes, it's telling you that traders are paying up for downside insurance. If they're rushing to buy puts instead of panic selling their stocks, the market can find a floor faster. That's why Tom leans into the idea that forward returns 1 week and 1 month out from spikes like this tend to be pretty good on average. He even tosses out a practical line. Ask him, are we higher a week from today? And he says the odds are good. Potentially even something like 60 points higher on the index in his mind. The spirit of that comment isn't a prediction to the decimal, it's a probabilities mindset. In this setup, history often rewards buyers, not sellers. Now, does that mean close your eyes and buy every dip? He's careful not to be glib. He acknowledges the headlines, China tensions, rare earths, the echoes of trauma from that February-April stretch when it was day-by-day panic. So, he isn't dismissing macro risk. His point is about structural forces. What made stocks attractive over the last 12 months in his framework is still intact today. The innovation cycle around AI, the efficiency tailwinds Wall Street is uncovering through blockchain infrastructure, and a Federal Reserve that's transitioning into an easing cycle. Those are multi-quarter, multi-year drivers. A scary headline can bend the path, but it usually doesn't break the backbone if the backbone is secular. Let's pause on those 3 pillars because they're doing a lot of heavy lifting in his argument. First, AI isn't just about one stock or one quarter. It's an investment cycle. Data centers, chips, networking, power, software layers, and then productivity gains that filter into margins and earnings. Markets re-rate when they believe an earnings base is moving up and to the right for years, not weeks. That's why AI has been the oxygen in this rally. Second, blockchain in his telling isn't some speculative sideshow. He's talking about the rails, settlement, tokenization, and back-office efficiencies, things that reduce frictions and costs in finance. When street infrastructure gets more efficient, profitability can improve even without sky-high top-line growth. That's a structural tailwind that's easy to miss during down days. Third, the Fed. If we're genuinely in the early innings of an easing cycle, moving from restrictive to less restrictive conditions, that historically supports risk assets unless inflation reignites aggressively. Rate cuts don't fix everything, but they lower the gravity on valuations and help credit-sensitive parts of the market breathe. Put those together, and you see why he calls today's sell-off a good flush. A flush clears out weak hands, refuels skepticism, and rebuilds what I call the wall of worry that bull markets like to climb. Notice how he frames it. Unless there's a real structural change, pullbacks are buyable. That's the conditional he wants you to remember. Headlines about rare earths or a bad Friday close might sting, but unless they metastasize into something that undermines earnings or liquidity for an extended period, they don't usually end bull markets. They create entries. He also mentions market character around Fridays and long weekends. Liquidity thins out, people shut down their terminals. Market bottoms rarely print on Fridays. Sometimes the real flush is the following Monday. That's not a rule, but it's good tape reading color. If we did close on the lows into a holiday, that alone isn't some death knell. It can just be the timing mechanics of traders stepping away. Let's translate all of this into practical takeaways. VIX spikes. Watch for exhaust, not just fear. When you see an options-led scramble for protection, it often means capitulation without full-on liquidation. That sets the stage for upside mean reversion. Separate structural from situational. Structural. AI capex cycles, blockchain efficiency gains, the direction of policy rates. Situational. A headline that hits supply chains, a diplomatic flare-up, a calendar quirk into a holiday. Situational shocks can be sharp, but they're usually short. Respect the path dependency. We rallied 36% off the April lows. Corrections inside uptrends can feel violent because the spring is tight. Pullbacks aren't a bug of bull markets. They're the fuel. They reset positioning and sentiment. Know your unless. Tom's unless is a real structural change, something that compresses earnings power materially or rewires financial conditions in a persistently negative way. If you don't see that, then treat damage as opportunity. Think in probabilities, not absolutes. His "a week from now the odds are good we're higher" isn't fortune-telling. It's about playing the tape with risk-reward on your side. After big VIX spikes, the historical batting average improves. You won't win every time, but your expected value improves. How would I trade or invest around this, given his framework? I'd avoid chasing breakdowns intraday and instead plan staged entries, scale in over a couple of days if we get that Monday flush. I'd prioritize names with direct exposure to those 3 pillars, companies levered to AI infrastructure and software adoption, platforms benefiting from blockchain rails or tokenized assets, settlement efficiency, and cyclical secular winners that historically respond well to easing financial conditions. For shorter-term traders, watch for classic reversal tells After a volatility spike, index undercuts that reclaim prior support, breadth thrusts on the rebound, and volatility that cools faster than price, those are early signals that hedging demand is abating. Risk guardrails still matter. Keep position sizing sane, define your invalidation levels, what would constitute a structural change for your thesis, and remember that headline risk can extend beyond one session. But the crux of Tom's message is that nothing we heard today, on its own, breaks the bull. If anything, the emotions around a sharp down day are consistent with bull market pullbacks that set up the next leg. So my bottom line after hearing Tom, yes, respect the macro. China and rare earths aren't noise, but weigh them against the backbone. AI's multi-year capex and productivity wave, blockchain's operational unlocks, and a Fed that's stepping back from restrictive territory. In that balance, a volatility pop looks more like a pressure valve than a trapdoor. If Monday gives us the flush, I'll be looking to put money to work. Not because I'm ignoring risk, but because the structure still argues that dips are opportunities until proven otherwise. So let's dive into the 3 undervalued stocks to consider adding to your portfolio right now. This video is sponsored by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Our first pick is Comcast Corporation, ticker symbol CMCSA, a true media and technology titan that's often hiding in plain sight, and right now it's trading at a discount that value investors can't ignore. While many people know Comcast as the company behind their internet or cable bill, the reality is that this business is a sprawling empire with its hands in nearly every corner of the global media and entertainment landscape. Comcast isn't just your local internet provider, it's the parent company of NBC Universal, which includes the iconic Universal Pictures film studio, a vast portfolio of television networks, and a global theme park empire that stretches from Orlando to Osaka. These are household names and world-class brands that touch millions of lives every day, whether you're watching the Olympics, catching the latest blockbuster, or visiting a theme park with your family. This incredible diversification is one of Comcast's greatest strengths. When one segment of the business faces headwinds, like traditional cable TV, another, such as broadband or theme parks, can pick up the slack. This balance creates a level of stability and resilience that's rare in the fast-changing world of media and technology. It's like owning several different businesses under one roof, each with its own growth drivers and opportunities. Take Universal Parks and Resorts, for example, with locations in the US, Japan, and soon China. These parks are cash machines, drawing millions of visitors each year. They're powered by blockbuster franchises like Harry Potter, Jurassic World, and Super Mario, which not only attract fans but also drive merchandise sales, hotel bookings, and repeat visits. The parks division has become a growth engine, bouncing back strongly after the pandemic and setting new records for attendance and profitability. Comcast's synergy across its divisions is unmatched. Hit movies from Universal Pictures become must-see attractions at the theme parks, which in turn fuel interest in the films and related merchandise. This creates a virtuous cycle, where each part of the business amplifies the others, driving revenue and brand loyalty across the board. Meanwhile, the broadband business is booming. In today's world, high-speed internet isn't a luxury, it's a necessity for work, school, entertainment, and daily life. Comcast's vast fiber and cable network gives it a major competitive moat, making it the leading provider in many regions. As more devices connect to the internet and streaming becomes the norm, demand for reliable, fast broadband will only grow. The market often fixates on the decline of traditional cable TV, but that's just one piece of the puzzle. Comcast is rapidly growing in broadband, theme parks, and streaming, all of which are offsetting the losses from cord cutting. In fact, the company is actively transforming itself for the digital age, investing in new technologies and platforms to stay ahead of the curve. Despite all these strengths, the stock remains undervalued. Comcast trades at an attractive price-to-earnings ratio, especially compared to its peers, and generates robust free cash flow. This means the company has plenty of financial firepower to invest in growth, pay down debt, and return capital to shareholders. Comcast's reach isn't limited to the US. It owns Sky, a leading media and telecommunications company in Europe, giving it a strong international presence and access to millions of new customers. The company is also expanding its wireless and streaming services, positioning itself for the next wave of media consumption. Peacock, Comcast's streaming platform, is scaling up quickly. With exclusive content, live sports, and a growing subscriber base, Peacock is becoming a serious contender in the streaming wars. As the platform matures and monetizes its audience, it could become a significant profit driver for the company. Financially, Comcast is a powerhouse. The company generates billions in free cash flow every year, which it uses to fund new projects, reduce debt, pay dividends, and buy back shares. This disciplined approach to capital allocation ensures that shareholders benefit from the company's ongoing success. Comcast has a strong track record of rewarding long-term investors. The company consistently increases its dividend and repurchases shares, signaling confidence in its future and providing a steady stream of income for shareholders. This makes it an attractive option for those seeking both growth and stability. Of course, there are risks. A faster-than-expected decline in cable TV or increased competition in streaming could pressure profits. However, these risks are already reflected in the stock's price, and Comcast's diversified business model helps cushion the impact. Any positive surprise, such as stronger broadband growth, a breakout hit movie, or faster streaming adoption, could quickly change investor sentiment and re-rate the stock higher. The company is well positioned to capitalize on multiple growth opportunities, and even small wins can have a big impact on its valuation. Many analysts argue that the sum of Comcast's parts, its broadband, media, theme parks, and international assets, is worth far more than its current market cap. This hidden value could be unlocked over time, especially if the company continues to execute on its strategy and deliver strong results. In short, Comcast is a classic value play, a diversified, cash-rich business with world-class assets, trading at a discount to its intrinsic value. For investors willing to look past the headlines and focus on the fundamentals, this is an opportunity to own a piece of a global media powerhouse at a bargain price. With Comcast, you're not just getting an internet provider. You're getting a leading film studio, a portfolio of top TV networks, a global theme park operator, and a major player in European media, all bundled together and currently on sale. It's a rare combination of growth, stability, and value. You're talking about a company with a market cap around $108.95 billion, generating $123.73 billion in 2024 revenue and $16.19 billion in net income. That's roughly a 13.1% net margin, and with EPS at $6.03, the stock trades at just 4.89 times earnings, implying a price in the high 20s, based on that multiple and EPS. For a vertically integrated media and connectivity player with that level of profitability, a sub-5 PE screams, priced for problems, which sets up asymmetric upside if execution simply stays steady. Comcast is a prime example of a great company that's often overlooked by the market, overshadowed by flashier tech names but quietly delivering results year after year. For savvy investors, it's a hidden gem worth a closer look. Let's move on to our next undervalued gem and see what other opportunities the market has in store. Next up is Charter Communications, ticker symbol CHTR, a company that stands as a focus play on the ever-evolving U.S. broadband market. In a world where digital connectivity is as essential as electricity or water, Charter has positioned itself at the very heart of this transformation, providing the infrastructure that powers our daily lives. Under the well-known Spectrum brand, Charter delivers high-speed internet to millions of homes and businesses across the country. As our appetite for data continues to skyrocket, whether it's streaming movies, working remotely, gaming online, or connecting smart devices, Charter's robust network is there to meet the demand. The company's reach and reliability have made it a household name, and the need for fast, stable internet is only growing as technology becomes more deeply woven into our lives. Unlike its larger rival Comcast, which juggles a variety of businesses from media to theme parks, Charter is laser-focused on broadband. This singular focus makes its story refreshingly simple and its operations highly efficient. By concentrating on what it does best, delivering internet, Charter can allocate resources more effectively, streamline decision-making, and respond quickly to market changes. Of course, no company is without challenges. The main concern for Charter is the rising competition from fiber optic providers and wireless alternatives. New entrants are eager to carve out their share of the market, especially in urban areas. However, Charter's vast established network and strong brand recognition give it a powerful incumbent advantage. It's not easy for competitors to replicate the scale and reliability that Charter has built over decades. One of the most compelling aspects of Charter's approach is its aggressive share buyback program. Instead of paying out dividends, Charter chooses to return value to shareholders by repurchasing its own stock. This strategy steadily reduces the number of shares outstanding, which in turn increases each remaining shareholder's stake in the company. Over time, this can significantly boost shareholder value, especially when the stock is undervalued. When Charter's stock price dips, these buybacks become even more powerful. Management is essentially signaling their confidence in the company's future by investing in themselves. It's a bold move that aligns leadership's interests with those of long-term investors, and it can lead to outsized returns if the market eventually recognizes the company's true value. But Charter isn't just sitting still. The company is actively expanding into rural areas, regions that have long been underserved by high-speed internet. By tapping into these new markets, Charter is opening up fresh sources of revenue with relatively little competition. These rural buildouts are often supported by government subsidies, making the economics even more attractive for Charter and its shareholders. Every new rural customer represents high-margin, recurring revenue. Once a household is connected, the likelihood of them switching providers is low, especially in areas where alternatives are limited. This stickiness fuels long-term growth and helps smooth out the company's revenue streams, making Charter's business model even more resilient. Charter's ambitions don't stop at broadband. The company has also made a big push into wireless with Spectrum Mobile, bundling mobile service with home internet. This integrated approach not only provides customers with more value, but it also makes them less likely to leave. The more services a customer has with Charter, the stickier they become, reducing churn and increasing lifetime value. The results speak for themselves. Spectrum Mobile is one of the fastest-growing mobile providers in the country, adding hundreds of thousands of new lines each quarter. This rapid growth in the mobile segment is creating a powerful new revenue stream for Charter, further diversifying its business and strengthening its competitive position. Yet, despite all these strengths, Charter's stock has been beaten down in recent months. The market is clearly pessimistic, perhaps overly so, about the company's prospects. Concerns about competition, regulatory changes, and the broader economic environment have weighed on the share price, creating what some see as a disconnect between perception and reality. It's true that Charter faces risks. Increased competition from both traditional and new players is a constant threat, and the company does carry a significant debt load from years of investment and expansion. However, Charter's strong cash flow and well-structured long-term debt give it the flexibility to manage these challenges. The company has a proven track record of navigating industry shifts and emerging stronger on the other side. The investment thesis for Charter is clear. This is a best-in-class operator with a focused strategy, robust cash flow, and multiple growth drivers. From rural expansion to mobile integration, Charter is executing on several fronts, all while maintaining operational discipline and a shareholder-friendly capital allocation policy. The current market fear has created a rare buying opportunity for patient investors. When sentiment is this negative, but the fundamentals remain strong, it's often the perfect time to take a closer look. Charter's stock may be undervalued relative to its long-term potential, offering a compelling entry point for those willing to look past the noise. Market cap sits near $35-44 billion on $55.8 billion of 2024 revenue and $5.8 billion in net income for about a 9.2% net margin. EPS is a hefty $36.54, and the multiple is only 7.10, translating to an implied price just under $260 on those figures. What I like here is the combination of consistent cash generation and a still discounted multiple in a scale connectivity business. If capital intensity moderates and pricing discipline holds, even small improvements in sentiment or growth could drive outsized multiple relief. If you believe in the future of U.S. broadband and the ongoing need for reliable, high-speed connectivity, Charter stands out as a compelling, undervalued bet. The company's dominant position, growth initiatives, and shareholder-friendly policies make it a unique player in a critical industry. With Charter, you're getting a dominant cash-generating business at a bargain price. The company's ability to generate free cash flow, reinvest in growth, and return capital to shareholders sets it apart from many peers. That's why Charter deserves a spot on your watch list. It's a company with a clear vision, strong execution, and the potential to deliver significant value as the world becomes ever more connected. Now let's shift gears and move to a different sector for our final pick, one that offers a completely different set of opportunities and challenges. Ready for a utility powerhouse? Let's dive in and explore what's next. Transition to next scene. Our third pick is Edison International, ticker EIX, a top electric utility serving 15 million people in California. This company is the backbone of energy delivery for a huge portion of the state, quietly powering homes, businesses, and critical infrastructure every single day. When you flip a switch, charge your phone, or drive past a glowing city skyline at night, there's a good chance Edison International is behind the scenes making it all possible. Utilities may seem boring, but EIX's monopoly and essential service make it incredibly stable. In a world where tech stocks can swing wildly and trends come and go, utilities like Edison offer a rare sense of predictability. People need electricity no matter what's happening in the economy, and that means steady demand, year in and year out. The company operates in a regulated environment, ensuring predictable earnings and cash flow. Regulators set the rates Edison can charge, which means the company isn't subject to the same price wars or market volatility as many other businesses. This regulatory framework is designed to protect both consumers and the utility, creating a win-win scenario that supports long-term financial health. Wildfire risks in California have weighed on the stock, but Edison is investing billions in grid hardening and wildfire mitigation. These efforts include replacing old equipment, installing advanced sensors, and using cutting-edge technology to detect and prevent fires before they start. It's a massive undertaking, but it's essential for the safety of communities and the reliability of the grid. These investments are added to their rate base, directly boosting future earnings. Every dollar spent on making the grid safer and more resilient is not just a cost. It's an investment that regulators allow Edison to earn a return on, which means more predictable profits down the road. California's legislative reforms, like the Wildfire Fund, provide a financial backstop and reduce catastrophic risk. This fund helps cover wildfire-related liabilities, giving investors more confidence that Edison can weather future storms, both literally and financially. The market is overestimating these risks, creating a value opportunity. While headlines focus on the dangers, savvy investors see a company with a strong plan, robust protections, and a clear path to recovery and growth. Edison is also a growth story. California's clean energy transition requires massive grid upgrades, and EIX is at the center of this multi-decade investment cycle. The state's ambitious goals for renewable energy and electrification mean Edison will be investing in new technologies, expanding capacity, and modernizing infrastructure for years to come. Every dollar spent on grid modernization adds to future earnings, making this growth visible and regulated. Unlike speculative tech investments, Edison's growth is backed by regulatory approval and a guaranteed return, making it one of the most reliable ways to participate in the clean energy revolution. Edison's non-regulated subsidiary, Edison Energy, helps large clients with sustainability, adding another growth avenue. This business works with Fortune 500 companies and major institutions to design and implement energy solutions, from renewables to efficiency upgrades, opening up new revenue streams beyond traditional utility operations. The market cap is about $20.05 billion, with $17.59 billion in revenue and $1.28 billion in net income for 2024, around a 7.3% net margin. EPS is $6.81 at a 7.65 PE, implying a price a touch above $52 on those numbers. For a utility, that's a low earnings multiple, and it suggests the market is still embedding elevated risk. The flip side is clear. If regulatory outcomes remain manageable and rate dynamics continue to ease, utilities typically see valuation support, and Edison has room for that mean reversion. Financially, EIX offers solid earnings growth and a healthy growing dividend. For income investors, that means a steady stream of cash flow, with the potential for increases as the company's investments pay off. For growth investors, Edison's role in the energy transition means there's room for capital appreciation as well. The stock trades at a discount to its historical average and the broader utility sector thanks to overblown wildfire fears. This disconnect between perception and reality creates a rare chance to buy a high-quality company at a bargain price, with the potential for both income and growth. Risks remain, wildfires and regulatory changes, but the downside is limited by the essential nature of the business and legislative support. Edison's services are so critical that the state has a vested interest in keeping the company healthy and operational, which provides a unique layer of protection for investors. The upside? A premium utility with a best-in-class growth profile, fueling the clean energy transition. As California electrifies transportation, builds out renewables, and pushes for a carbon-free future, Edison stands to benefit from every step of progress. Edison International is a quiet powerhouse, stable, growing, and undervalued. It's not flashy, but it's the kind of company that quietly compounds wealth over time, providing the foundation for a resilient investment portfolio. It's the kind of stock that anchors a portfolio and lets you sleep well at night. While others worry about market swings or chase the next big thing, you can rest easy, knowing your investment is backed by real assets, essential services, and a long-term growth plan. While others chase trends, you can build wealth with this essential service provider. Edison International offers a rare blend of safety, income, and growth potential, qualities that are hard to find in today's market. Let's wrap up with your next move. Consider whether Edison International deserves a spot in your portfolio. With its combination of stability, growth, and value, it just might be the quiet powerhouse that fuels your financial future. There you have it, 3 dominant companies with strong cash flows and growth prospects, all trading at deep discounts. We covered Comcast, Charter, and Edison International, each a unique opportunity for long-term investors. The key? Look past short-term noise and focus on business fundamentals. Stepping back, the through line is straightforward. These are established operators with real earnings power trading at single-digit PEs, Comcast at 4.9x, Charter at 7.1x, Edison at 7.7x, versus a market that often demands 20x for growth and 15x, 18x for defensives. None of them needs perfection to work, they just need stability. In an environment where volatility shakes out weak hands, names like these can quietly compound, and if sentiment normalizes, the multiple alone can do a lot of heavy lifting on returns. Want more in-depth analysis and exclusive stock tips? Join the Stocks Galore Patreon, link in the description. Which of these undervalued stocks do you think has the most potential? Drop your thoughts into shoppins, 𝗗𝗟𝗨𝗦𝗧 𝗗𝗟𝗨𝗦 the 𝗗𝗜𝗦𝗧 𝗖𝗢𝗗𝗘 Podins nan, 𝗷𝗟𝗬𝗏 𝗖𝗢𝗄𝗙 Shockins and shopping scene, walking some mean a burin, talking Scots inside, shopping staffy side. Don't forget to like, comment, and subscribe for more investing insights. Thanks for watching. Buat the dream. See you in the next one.